This is the most significant stock market chart I've come across in my trading career. And what it is telling you is that the performance of the stock market, okay, after the cash market closes at 4 p.m. and before it opens at 9:30 a.m. the next day, the performance is orders of magnitude higher. We're talking more than 10x, right, than the performance of the stock market during the day trading session. And what that is telling you is that the overnight futures market, which is where the trading occurs after the cash market closes, there's a lot of increased activity to both the up and the downside. And that's where a lot of the money is made, actually, over time. And this chart is proof that that is, in fact, the case. And if you actually take this one step further, I have multiple versions of this chart to show you. In this version of the chart, it shows you what happens after hours in blue, which is the obvious, outperformer here. And it shows you also the, during the day trading session, during the cash market, open and close. It's actually negative. This chart went up to January 2019, actually. So, you actually would have lost money. And then if you look at the full day, which incorporates both of them, right, you'll see that the gray line is showing you that it's not as well, basically because of this drag down from the day trading market. So where I live and where I like to make money is, guess where? It's not during the day, right? I hold my positions overnight. And that's the little secret I wanted to share with whoever's watching this. Most people don't understand that that is actually over time where most of the money is made. What they do is they go into the trading session in the cash market and they get all it gets very complicated and they try to figure out what's going on through a lot of technicals. And I don't do that because, number one, it doesn't perform as well. And I'd like to focus my attention of what happens in the overnight market, which you can't really control because the cash markets are closed and pretty much it's just the futures, and not everything has a futures market. So it's really knowing how to position yourself, not trade during the overnight session, but how to position yourself before the market closes so that the next day when the market opens, you can take profits. Now this is an updated chart. Sorry for the low resolution, it's the best copy I could find. But basically, extending from the end of the other charts into Jan 2024 and further into actually 2025, you'll see that during the market runs up, it has outperformed. I mean, we're barely hitting zero here during the trading session, right? This is insignificant performance. I mean, for such a long time, since '93, whereas we're over 1,000%, 1,000% in overnight returns, right? If you understand this, you'll understand how to make a boatload of money. However, I do want to say here that it goes both ways, right? So when there is a downturn, like in the COVID, crash, look how significant it went down, right? Same with the downturn in 2022. And so it goes both ways, right? It shoots up, but it also shoots down. So people like to play with margins and leverage. I don't do that because, like I said, my trading account, it can evaporate and I'm fine. And that's the way I operate. I never want to take loans out to trade because I never want to go negative and have a capital call and have to pay out more than what's in my trading account. So I have that sandbox. But the way I can boost it and juice it without taking leverage and debt is to actually trade in the overnight markets. Because as you can clearly see here, it is a magnifier of moves. And another way to magnify your gains and hopefully losses won't be magnified because you'd be positioned short, right? And either up or down, you basically magnify the returns that you can make. And I don't know how many people know this, right? And some people might know it and don't do anything about it. But I know this and I've been acting on it. And it has really made a difference in the amount of, number one, it made a difference in the way I invest because I don't get, too boiled up in the intraday, cash market shenanigans. Instead, I actually position myself on how to, make a profit before the market closes so that I can, when the market opens the next trading session, I can make some good profits. And if you've seen the way I invest in my previous videos, you see that that's the way I invest. I don't get so caught up in all the little, details of every tick and move during the cash markets when it's open during the day and just position myself for overnights and over weekends so that I can take profits. So how does this translate into what's been going on more recently? Well, if you look at what's been going on more recently, we've had this situation where essentially we had this the cycle of doing this, right? And the last 3 weeks, basically, if you saw my earlier videos about DeepSeek, that Sunday before the markets open, I was positioned short and DeepSeek happened and we had this huge, right, drop down and then we had this rally up and then the tariff news hit again on the weekend, and on Monday we had this huge drop down, then we had this run up again, and again this tariff 2.0 / inflation fear hit on Friday and we had this huge drop down. And so the question is, what's going to happen here, right? And every Sunday for the past 3 weeks, I'm like, yo, I'm short, man, because it's going to crash. And then I cash in right on the Monday open, right? And so this is an example of how holding overnight, in these cases, holding over the weekend, actually translate into ways you can make money, even if you're short, because you're preparing for the blow off top in the bear market in a rising or sideways trading market. Now, the last 2 times, right, it gapped down big. And it was a gap and trap, meaning like Johnny-come-lately bears who came in and tried to short the market after a huge gap down got their faces ripped off because there was a massive rally. And the same thing happened again on Monday last week. And so the question is, will the same thing happen again this week? And I do believe so, right? However, this time, third time's a charm, so it's going to be slightly different. Let me explain to you why. The reason is everybody's looking at this, right? I can't tell you how many posts there are on social media saying like, hey, look, we've done this, we've done this, we've done this, so we're probably going to do this, and then we're going to go out and maybe break out. And so that's basically the herd mentality. And as you know, I hate trading what the herd does, right? Because the incremental gains following the herd isn't worth the monumental gains you can make if you trade against the herd. But it's harder, right? Because you have to know these pivot points. And what I do think is going to happen is, yes, I do think we're going to go down. I think market's going to open Monday again and gap down again. But this time, I may not cash out, unlike the other 2 Mondays. Because what I think is going to happen, since everybody is thinking this is going to happen, is I actually think it's going to go down further this time. The third time, I think we're actually going to break this and we're going to go down further. And the reason why I think that's going to happen is because the market makers know everybody's looking for this, right? So what they're going to do is what is known as a stop loss run, which all the traders have like, okay, if it reaches here, automatically sell my position so I don't lose, money. And guess who sees all those, right? The market makers. They can see everybody's stop loss position. So you'll do a stop loss run, just go all the way down, suck it up, get everybody out of the market, and then go up after everybody's been kicked out. That's most likely, in my opinion, what's going to happen on Monday. So I do think we're going to go down, we're going to have this, and we're going to break this, and we're going to go into this gap, which has never been filled. This was the CPI gap. Remember the last episode I told you there were 3 gaps. We filled 2 out of the 3, and likely we're going to fill the third one because just inertia, we're going to fill it. And so that's going to come down here, which will be lower than the previous low, and that's going to spook everybody, right? Everyone is going to panic then and be like, oh my God, we broke the low, so it's going to go down here and then go up. That is what I think is going to happen. We've got pretty major news, particularly the CPI report coming next week. So we do have news events that can be backwards explained into the market technical movements. Now, let's not forget, the amount of cash that has come into the U.S. stock market from around the world, right? It's not just within the U.S., is insane. This amount surpasses what happened in the dot-com boom and bust, that bubble, right? We are now in new record territory of how much money has sloshed in to the stock market. And that is a sign. And these are years, right? So we're not talking about weeks or months. These are years. So I'm not saying tops in tomorrow, but last time I said that we'd had a huge crash, but I don't think so. Just because of the timeline here. So even though we're at these elevated record levels, that doesn't mean it's like tomorrow or next week or even next month it's going to come crashing down. This is, just this circle I drew is already many, many months, right? So what this is telling you is in the long run, right, longer term view, this is not good. When too many people are in the stock market, particularly people, right? We're talking retail traders that are in, that's not good. That's time to get out. And, guess who's been out, right? Our good old friend Warren Buffett, smartest. He's basically the GOAT investor, like he's Michael Jordan of investing. He's been out, right? And I've talked about this in so many episodes, I'm not talking about it anymore. But over the past year and a half, he's been scaling out of his positions to where now his cash pile is the most it's ever been in the entire history of Berkshire Hathaway. So that is something to not scoff at, right? The other thing I wanted to bring up is this chart. This is an interesting chart. This is basically the realized volatility of essentially the Mag 7 or the concentrated stocks versus the realized volatility of the rest of the market, the rest of the S&P 500, right? So what this is telling you is that, in a nutshell, the blue line, which is basically the concentrated stocks, wow, the realized volatility is high, meaning like they have suffered and will experience increased volatility. We saw this with Nvidia and all the other Mag 7, right? Amazon, they big moves up and down. But what is shown in red is that the rest of the stock market, right, outside of those guys, hasn't really realized the same levels on volatility. And so, what that means is either two things. Either the volatility of the Mag 7 and the concentrated stocks is going to go down, and this blue will come down to where the red is, or the red is going to come up to where the blue is. If the red comes up to where the blue is, meaning the rest of the stock market volatility is realized, that means the stock market index, which is made up of more than just a handful of stocks, right? That's why it's called S&P 500, is going to go down, meaning there's going to be an index level move in volatility, probably to the downside. And so when that happens, which I think will happen, we will have that scare, and that's when a lot of people will get shook out of their holdings, and after that the markets will rocket up higher, which I plan to trade on. If you look at what happened in the previous instances of this, like if we look at in July what happened, there was a pretty the red caught up, and what happened in July, right? We had quite a bit of a correction, and same thing towards the end of last year in December. We had the December sell-off, right? It was way lower than the blue, and it caught up. And so if you look at this, the chances are, based on the volatility, I thought this is a very interesting look at it. The rest of the market, the index funds, basically, they're probably going to catch up in terms of volatility. Now, this is just keep it simple, right? What I'm looking at, all right, for this overall topping process, and we have had a bull run for over, since 2007-8, so we're talking a 20-year bull run, right? The top is not going to happen in a month, okay? For such a long bull run, we're going to have a topping process, and it's generally going to go something like this, and we're going to have this sideways trade, which I think we've begun, right? The sideways trading action before the bear market starts, and we have the 20% plus drawdown crash that kicks it off, and then the waterfall that happens afterwards. So this is a very, very simple trading plan, right? Over a couple of years. And even if you have a trading plan, executing it is not easy, right? Now, one of the things I wanted to bring up here is this interesting chart that I saw the great Maris posted. And he's basically comparing what happened in the 07-08 top, which I've done before, and what's going on now, right? So what happened was we had this run up, and then we had this sideways trading action, which we broke out of and made a double top, and then we had the collapse. And we are doing something quite similar. We had this action, sideways trading, then we broke out. We went all the way up to where we are now, and now it looks like we may be forming a double top here. And so it is interesting to note that, right? Could this double top be it, and then we go down like that? I mean, it is possible. However, I just don't think there's always going to be an exact carbon copy replica of what happened in the past and in the future. And so what I do think, and that's too easy, because I do think what's going to happen is we're going to have some, like correction, perhaps all the way down here, but I do think we're going to have a shoot up, okay? to make a new all-time high or just squeak one out before it all unravels. And that, I think, is the market likes to make money on both sides, both the bulls and the bears, and it likes to do things that are not expected. And that's, in my opinion, something that's not expected, right? To have it go up and squeak out another new all-time high and suck in the last of the bulls before the bear market starts. That's probably what's going to happen. Obviously, nobody has a fortune telling ball, so we kind of just take inputs as the price action tells us what's going on, and with other parameters, and then we adjust accordingly. But that's essentially the longer, midterm trading plan I have in my head. Now I want to talk a little bit about the debt market, the U.S. debt market in particular. There's been something going on recently that's been going around, making the rounds, and that's the reverse repo facility is near zero. And what that facility is set up to do, it's one of the ways for the Fed to manipulate and manage liquidity, and it's almost at zero, right? It's almost gone. So that means the liquidity is almost gone. And in so many words, that means the government, right, the quantitative tightening cycle is kind of over. And if we look at what's going on, look, this amount of government spending is, number one, it's not sustainable, but number two, it's also a big reason of why we've had so much growth and why we've averted recessions for so long. It's because the government's just been pumping money into the economy with government jobs, government projects, blah, 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 government hiring. And we're at this stage where it can't go on anymore, right? Both politically and financially. On the political side, I'm not going to talk too much, but you hear what's going on with the Doge and like what Trump and Elon are doing. And make no mistake, right? When they start slashing like USAID and all this stuff, they start cutting down. And once they get access to the Treasury, which they're in the middle of trying to, even though they're getting some roadblocks, that means less government positions, less employees, less projects. And that can only mean one thing. That can only mean that recession and the contraction of the economy is going to begin. Right? There's no other way. If you cut the spending, that's what's going to happen, because the spending is what's been keeping the growth up, right? And how we've avoided a recession, basically zombied out with government spending. And so that's coming, right? The only way out of that is if the Congress votes to spend more again and go into bigger debt, right? And outdo what Trump and Elon are trying to do, which that's a political thing I'm not going to get too further into, but that's what's happening on the political front. But on the financial front, I just want to show you this, what's going on over here, which is the amount of debt maturing and that either has to like come clean and be paid off or refinanced next year for the government of the United States is over 9 trillion according to Bloomberg, right? This is off a terminal. And if you look at, we're at 9.1 trillion is coming home to roost in 2025. So the government has to figure out how to manage that. 9 trillion is not a small amount of money, right? So they're going to have to figure out one way or another on how to manage that maturing debt basket. And that's actually part of the reason why yields are going up in the US, even though the Fed has been cutting interest rates. The interest rate for yields have been going up. And a part of the reason, aside from scares of inflation, is they don't see how the government's going to be able to manage this. And I don't fault them. I mean, what you going to do, right? Something's got to give. You can't play God and have your cake and eat it, right? No matter how much financial wizardry we think we've matured into, we're not God, right? There are things that have to give, and the question is what will give, but something is going to give, and that's probably going to be one of the triggers for a financial crisis, which usually comes packaged together with a recession. I'm not going to sit here and pretend I know what that trigger is, but make no mistake, there will be a trigger. The last thing I want to talk about is gold. Now, I'm a gold bug. My entire life savings is mostly in gold. This trading account is just, funny money that I do for, making, some money on the side. But gold is, my gold has like increased by over 50 to 70% just in the past year, right? Just sitting there, gold bars in a vault. And if you look at this chart here, and this is a chart by North Star, which it's a great chart. It actually tells you what is going on. Now, this is basically gold versus the New York Stock, composite. And essentially, when you have this ratio right, and you have a breakout over here that's about to happen, that means a new gold bull era is about to begin. And if you look at how long these eras last for, we're talking about 5 to 10 years plus, right? And we're just about to have a breakout here after correcting for like a really long time. Look, this is 2012 to 2024, right? So decade plus of just meandering around in the correction phase, and we've broken out. That should tell you something. Look, in the past, we've had these runs that have gone this high, right? It is very likely we're going to go up there again. And let me show you another chart of gold cycles. First, to tell you that these cycles take time, right? So if we're going to enter this, it's going to be a long, now this is a exponential price chart, and we're probably going to have, the question mark is over here, because we're probably going to have a measured move, right? Move up, consolidation, measured move up, somewhere around here, right? We're talking about 5,000 plus to 10,000. Look, the last time we had this run up, huge consolidation, and then a run up again. This is a measured move that's somewhat similar in height. This measured move, this run up, is probably going to end up with another similar height. And if we look at that, we are talking about prices going way higher. Hey, sorry about that. That was actually my doorbell. I had to go get the door. Just donating some of my stuff to a local school here in Bali, special needs school. You know, I'm actually in the middle of moving right now, so I took a little break to make this video, you know, because, you know, this video is more important than just moving, right? In fact, let me show you the mess that I'm in right now. So this is our living room, and it's just a total disaster.
Compton and Long Beach together, now you know you in trouble, cause ain't nothing but a G-bang, bang, two loped out G's, so we crazy.
And yeah, we're moving out of Bali. This was a villa that I'd been staying in. Actually, my wife and my kids have been staying in for a little over a year now, and heading back to Singapore. But you know, Bali wasn't all that it was cooked up to be, at least not for us. And you know, I'll make a video. You know, we're definitely going to make a video about our experience in Bali and why we decided to move out of it and all that. But back to the action here. Look, as I was saying, you know, the gold cycles dictate that we're probably going to have a measured move all the way up to, you know, this is a measured move up here, measured move probably up to 5,000 plus, right? At which point, when we do get, and again, it's not timing the market or timing the market, it's just having price targets, right? And so the price target of around 5,000-ish is a place where I could contemplate about maybe converting some of the gold bars that I own into other assets at that time, because, you know, if that happens, I think there will be good bargains and discounts to convert. But let's not get ahead of ourselves. We still need to hit 3,000, and, you know, nothing goes up in a straight line. But long term, that is what I am looking at. And the interesting thing is, what's going on with the gold run? So you know about bank runs, right? You go to the bank, they don't have your cash even though you want to take your money out. Well, basically that's going on with gold, especially with the Bank of England, where people have demanded their gold back because everybody's moving the gold to COMEX over in the US, as you can see here. I mean, dude, that is a serious spike up, right? In terms of, you know, gold coming into COMEX. And look at the daily change, and we haven't seen this since like the COVID times, right? And so that has caused this. Now, here's the interesting part. We kind of saw this in COVID, but we didn't have the Bank of England come out and delay the delivery, as I said in my last episode, of how long it would take for you to get your gold bars back. And this time they did, right? So this move up here, while it looks similar to the move up here, there's more things going on underneath than we see in these charts, because they have resulted basically in the Bank of England essentially defaulting on their promise to give you your gold back by a certain amount of time, and they're just trying to buy time here. And so we could be on the cusp of some serious explosion in gold prices. It is not off the record here. You know, it's within the realm of probability now, right? Because of what's going on fundamentally, and then also we see in the price action. And if that does happen, well then, You might ask, what about its little brother, silver? Now, people have been asking me about silver in the comments in the past episodes, and I've always said, like, silver is always the little brother to gold, and, you know, it's more volatile, and it takes longer for it to catch up, typically. And so I don't, you know, really play silver in that sense, and it has been kind of volatile. But, you know, if gold really has that, like it did back, you know, here, has this huge spike move back up, then, you know, if we do this again, and this is happening, then like before, silver will catch up, and there will be a point where it'll eclipse the run-up in gold. And at that point in time, it'll have even higher gains, because it's, like I said, it's like even more volatile and, you know, than gold in terms of its price action. And we may be approaching that point. You know, we may actually eclipse the previous all-time high of silver and go into the 50s, right? If gold does go to the 5,000 area, silver will have an even higher price appreciation. Now that comes with a lot more risk, which is, you know, that's why I don't do silver, because if we're talking about risk, I have other things that I can put money into that's, you know, got a lot of returns for the risk. You know, the risk return premium is a lot better, like with volatility and other things. So that's why I don't do silver. You know, gold to me is a safe play. It's a hedge against, it's for safety, basically. And it happens to also appreciate in terms of fiat currency. So it's a double win for me. But for people asking about silver, yeah, I mean, I do think that we could be entering this phase. And the other thing that we could be entering, and this is something I may potentially play, are the gold miners. The stock for the gold miners has not been following the price of gold at all, which is kind of counterintuitive. You would think if the underlying asset to be mined from the earth, the value goes up, well, the miners would go up in terms of valuation in their stock price. But that absolutely hasn't happened. One of the reasons why is the cost to mine has also gone up due to inflation and all that. But so Newmont is one of the largest it's the largest gold miner, right? It moves the market. And if you look at the price action of Newmont, you're seeing something where it's got a massive inverted head and shoulders, right? Like shoulder, head, shoulder. And this is about to break out. And again, if that's the case, we're looking at a measured move all the way, you know, we're going from, you know, the low 40s to like possibly the low 60s, which is a huge move up. And that is a single stock in a, you know, so if that does happen, I'm a big bull for the gold miners, right? I don't know about the junior miners, but GDX. So if we then go to GDX, which is the ETF for the gold miners, you'll see that it too has a similar, you know, head and shoulders formation that it's closely, that's why I brought up Newmont, which is the largest one because it's driving the market. But, you know, look, it was about to curl back up here. And so this is very similar and reminiscent to what we saw in the dollar. Remember, dollar after multiple years, this is also a multi-year time period, consolidation underneath resistance, and then it popped over, and I said like it would retest the overhead resistance to act as support, which is happening for the dollar, and this could very well happen for GDX as well. So there are a couple of entry points here. You see if it breaks out, you could put money in, and then if it's retest, you could put more money in, or just wait for the retest after it breaks out. And if it goes back up after retest, that's a very safe entry point for GDX with probably, you know, it has a lot to catch up for gold, right? So it could go up quite a bit. Kind of like the moves as a Russell 2000 were making, you know, these huge moves up and down. I would think the miners would have a similar type of price action. So these are things to look out for. I don't know if I'll play the miners. I might play a little bit. Same thing for silver, but basically I'm keeping my gold. I may add more to it if I see drawdowns, but you know, essentially I'm looking at a price target of over 5,000, which would be like a crazy increase for me, right? Because I got it about 150, like, you know, $1,500. So if it goes to like 5,000 or above, you know, I'm looking at 300-400% return on what is supposed to be a safe, non-risky asset, right? So the risk to reward ratio is super favorable here, and yeah, I mean, you know, that's basically my life savings, right? So this trading account, you know, a couple of, you know, 10,000 here, 10,000 there a week, you know, that's great. You know, it's good side income, but it's not my main savings account. And if I can continue to make this kind of cash, I mean, that's a very, you know, as you know, FoFty started because I quit my job, and I just didn't want to do corporate anymore. And now, one of the side things I do is this trading, and it's good side money, right? And it's enough to sustain, and something I can do on the side for basically forever until I pass out, right? Or peace out, rather. And so, I haven't posted much about FoFty because I'm very busy writing the manuscript on how to live life the FoFty way. But once that is done, I'll be posting more about that, and you'll hear more about basically my lifestyle and how, why I quit my job even though I'm 50 and have 2 young kids, to pursue a FoFty life. But interfacing and making money on the side is part of it, right? And so one of the ways I do it is through this trading. And I want to share this trading stuff with people who want to listen because, it's entertaining, plus, it's knowledge, right? And what you do with that knowledge is up to you. I'm not an investment advisor, but it's just knowledge I'm sharing for free. Like I'm not charging money for you to buy some, join a Discord server or buy some, training course or something like that. Like, this is just free stuff I'm sharing to people. So having said that, let's see what happens with the market when the futures at least open in a few hours from when I post this. And let's see if, the trading plan comes to action, make another 10K in a week next week. Having said that, I'll see you in the next episode. Peace out.